some of the multiple choice questions from AS level accounting regarding the adjustments to financial statements. For each question, you'll see exactly which paper it came from. Let's look at this first one. A trader sends his staff on a training course costing $100 per person. 10 staff attended in April and 4 in May. Half of the total cost had to be paid at the start of April and the balance at the end of May. Which entry for training was made in the statement of financial position on the 30th of April? What you need to do over here is start out by working out what the April cost should have been. $100 for 10 staff who actually attended is $1,000. Then work out what the May cost would be, is $400, because you've got $100 times 4 staff members. This means that your total cost would be those two amounts added together, in other words, $1,400. It tells us that only half of the cost actually had to be paid at the start of April, so that would have been $700. So therefore, what would need to happen is for in the statement of financial position, you would need to account for the missing amount of $300 that is still owing or accrued. This $700 plus the $300, in other words, the $1,000, would have been shown in the statement of income. On the statement of financial position, which is what is asked, you need to show $300 accrued, and that's why you would choose A as your answer. Notice that I didn't look at any of these answers until I had actually come to what I thought the answer should be. Then I will go and find it over here, and hopefully it is there, and in this case, yes, it is. Let's look at the next one. Number 3. A business paid $10,000 for motor expenses in the year. The opening prepayment, in other words, paid in advance last year for this year, was $1,500, and the closing accrual was $2,000. What was the charge for motor expenses for the year? The easiest way to work this out is to draw up a rough T account to illustrate what happened to the expenses. You would show the opening prepayment or the prepaid amount as $1,500 on the debit side, as in fact it is a receivable or an asset that you've paid in advance. The actual payment of $10,000 would also go on the debit side as it increases the expense. At the end of the year, the fact that you still owe that $2,000 means that you would want to increase your expense on the debit side, and then the actual accrual in the accrual account would be shown as a credit, in other words, a liability, as you still owe that money. So you have 3 entries on the debit side, which means that the amount that you need to send to the statement of income on the credit side would simply be those 3 amounts added together, or $13,500. You will see that I always highlight the figure that we're trying to work out in green. So $13,500 is what we are looking for. If you look at the options over there, you can see that it's D that we want to choose. Number 4. An item of revenue expenditure is wrongly treated as capital expenditure. What is the effect of this error on both the non-current assets and the profit for the year? Well, if you've got revenue expenditure, in other words, it is actually something that should be shown as an operating expense on the statement of income. But if you treat it as capital expenditure, it means that you are recording it as an asset. So what you need to do is you should realize that it should be expenditure, but it's not. So your expenses would be understated and therefore your profit would be overstated. It should have been treated as capital expenditure. It was treated as capital expenditure, but it's not capital. So it means that your assets would have been overstated. So let's go look for an option that has both my assets and my profit as both being overstated, and that's how I will arrive at my answer being A. Number 6. A trial balance at the 30th of June, before making end-of-year adjustments, showed the following. You've got trade receivables of $35,600 and a provision for doubtful debts of $1,160 given to you. At the 30th of June, it was decided to write off a bad debt of $1,600 and to make a provision for doubtful debts equal to 2% of trade receivables. What was the total decrease in the profit for the year ended 30th of June, arising from bad and doubtful debts? So over here, they want the total expense. And it is quite important that you don't miss out on that fact that they also want the bad debts, not just the doubtful debts adjustment. Remember, the doubtful debts themselves would simply be shown as a negative to offset your assets and current assets to work out the total net trade receivables. But the adjustment is what would be shown on the statement of income. Let's go and look at it bit by bit. Firstly, let's work out that your receivables, we are given $35,600, but you need to write off a bad debt of $1,600. So you have to say minus $1,600 to show you that your receivables is $34,000. Remember that this provision does not actually go in the receivables account, so we can ignore it for now. The provision must become $34,000 that we worked out over there times 2%, which gives us $680. So if we recreate the provision for doubtful debts account, the beginning credit balance is 1160. In other words, that was the provision that was created or adjusted to last financial year. And that's the amount that was given in the trial balance. But this year, I want it to be 680. If you compare these two figures, you can see that you need to decrease it by 480. So that will be your adjustment that should go in the statement of income. And in actual fact, hopefully you also realize it is an income in that statement of income because you are reducing your provision for doubtful debts. So from there, we can now work out the total because this 480 is only part of it. We are asked to work out the total decrease in profit. In other words, the change in the net expense. So we need to factor in our 1,600 bad debts, but at the same time, we also need to adjust for the provision adjustment that we made, which means that the actual effect is not the full 1,600, but only 1,120, because the bad debt is an expense, but this provision adjustment is an income which offsets it. So my answer needs to be a 1,120, and I would therefore choose B as my answer. Number 8. At the 1st of January 2014, a business had prepaid rent of $700. In July, it paid an invoice for $9,300, and on 31 December, it transferred an expense of $9,000 to the income statement. Given the fact that they haven't given much more information, we have to assume that this $9,300 and the $9,000 over there are also both referring to the rent. So now that we want to work out the value that appeared in the statement of financial position, what I'm going to do is I'm going to recreate the rent account to see how much was actually prepaid or accrued or whatever at the end. So I enter my 700 prepaid at the beginning. That was an asset amount because it was prepaid in advance. So it was either the rental is owing to me or the use of the property. I will show my payment of $9,300 also on the debit side because it's an expense. And then over here, I will show the $9,000 that was sent off to the income statement as an expense. That means that I've got a missing figure here of $1,000. So you work out $1,000 as your missing figure. And hopefully the fact that it is shown on this side here is indicating that you are trying to reduce your rent expense. In other words, it was prepaid or receivable. And you could also go so far as to think about the other T account, if we had to show it, would be the prepaid account. And that would need to have a debit balance because this is a credit. And if it has a debit balance, it must be an asset. So therefore, I want to look for an amount of 1,000. So either C or D would be my option. And I need it to be a receivable. And therefore D will be my answer. Number 11. The creation of a provision for doubtful debts is an example of which accounting concept? What we're going to do here is we are going to look at each one. Or you could actually start by saying, what do you think it is? Well, if you're creating a provision for doubtful debts, that is where you are trying to have a fair reflection of the actual state of affairs of the business. In other words, you don't want to say that people are going to pay you more than they actually will. So it would be your fair presentation IFRS concept. Let's go and have a look for it. Business entity, what is that? That means the owner and the business are recorded separately. So this is where you would have drawings, etc., being shown separately to the business expenses. So that does not apply. We won't want that one. Consistency means that the same policies are applied year on year to allow comparison. That also does not support this point. Number C, prudence. Yes, prudence is an option. Remember that prudence is an old GAAP concept that refers to being conservative. In other words, you will record possible losses that may occur, but you wouldn't record possible profits. However, these days we do prefer to refer to IFRS. It certainly is, the fair presentation is a better concept to quote. But if prudence is given to you as an option, as it is in this case, that will certainly be the one that you will choose. Let's just check number D, realization. Realization isn't really an accounting principle like business entity, consistency and prudence, etc., but it is an idea or a term that we do use, and what it means is it simply refers to how much you will get for an asset when you sell it. So think of your net realization value or net realizable value. Realization is simply when you are selling the asset. So again, that is not applicable. Therefore, of all of these options, we like C best. Number 13. A business depreciates its motor vehicles over 4 years using the straight line method. In other words, 25% of the value every single year. When I say value, remember that I mean the value that we are going to use up. A full year's depreciation is charged in the year of purchase, but none in the year of sale. Although this is not necessarily very realistic, it certainly does make for easier accounting in your case. A vehicle purchased on the 1st of July for $18,000 had an estimated residual value of $4,000. So you can now work out what the depreciation should be. You would need to start with your cost and then subtract the residual value, or what it will be worth at the end of those 4 years. So that means that you are going to use up or benefit from $14,000 worth of this asset. Divide that by 4 years, means that you will charge $3,500 per year depreciation on this particular vehicle. You would depreciate it first on the 31st of December 2011. That is your first financial year. And even though you've only had it for 6 months, the instruction tells me that we're going to charge a full year's depreciation then regardless. So we will charge the full $3,500 in 2011, also in 2012, and in 2013. However, when it was sold on the 31st of December 2014, because it tells me here none in the year of sale, even though we have actually had it a whole year, we won't record any depreciation in 2014. So that means that the total depreciation is going to be $10,500 over the entire life of this asset. Which entry appeared in the income statement for the year ended 31st of December 2014? Well, if we had charged depreciation, it would go in there, but obviously there's no depreciation in the year of sale, so we shall ignore that. But we do now need to take into account whether we've made a profit or a loss. So to do this, let's draw up the disposal account. On the debit side, you would show your vehicles, $18,000 cost. On the credit side, the accumulated depreciation of $10,500 that we worked out. And you can also show your selling price of $5,000 on the credit side. This loss then of $2,500 that has just been worked out over here would be the loss that will go onto the statement of income. So let's go and see if we can find that as an option. And you can see B suggests a $2,500 loss, and so that is what we will choose as the answer. Right, the next paper we'll look at is Cambridge, November 2015, paper 1-3. Let's look at question 3. A bookkeeper failed to record accrued rent payable of $12,000 at the year end. What is the effect of this on the financial statements? You can see that we want to look at what the effect is on the assets and the effect on the profit. So we're going to work both of those out just for ourselves. Firstly, consider the fact that the rent expense would be understated because it's rent payable. In other words, we owe that rent, we have not yet paid it, and it has not been recorded. So the expense that we've shown is too little, and therefore our profit would have been overstated. On the other hand, what we should have done is shown that there was a liability of $12,000 that we owed. So because we didn't, our liabilities are understated, and that means that our net assets, in other words, assets less liabilities, would have been overstated. So you look for an option where both are overstated, and you can see A would be the one that we could choose. Number 8. A business makes a provision for doubtful debts equal to 10% of trade receivables. It's quite high. One could actually question why they are not managing their debtors a little bit better, because 10% of all the money that is owed to you, or of your total sales, is a very, very high amount. So it means that if you sell something for 100 Rand, you only expect to get 90 Rand back again, and it will have a huge impact on your profit. So one would need to question why it is that high. You would expect the rate to be about 4 or 5%. The provision at the 31st of March was 8,300. Receivables after the provision was 55,800. Notice this word after. If you miss that, it's going to throw you out for this whole question, because trade receivables after the provision means that the provision has already been subtracted. So this amount over here, in fact, represents only 90% of the total receivables. As soon as you pick this up, make a little note for yourself, or you will end up struggling here. What is the change in provision over the 12 months? Well, before we can even worry about that, we need to factor in this little piece of information there to see what is the trade receivables at the beginning. And the way that you'll do that is you'll take your 55,800 that was given, and in effect, the easiest is to just say divide by 9. But what I'm doing here is I'm saying that what I'm looking for is 100% of the 90% that this represents. So you can work backwards to find out that actually the total trade receivables is 62,000. This means that the provision at the end should be 10% of the 62,000, not 10% of the 55,800. If you wanted to, you could do a shortcut where you simply say the 55,800 times 10%, because we know we're looking for 10%. But instead of saying over 100, you have to say over 90, because that only represents 90%. And you would then work out 6,200 as what you want your provision to be. Once we've got to that point, you can then recreate your provision for doubtful debts account, showing the 8,300 that it was, the 6,200 that it must be after we've worked all of it out, which means that you would need to adjust it or decrease it by 2,100. We go and look for a decrease of 2,100, and you can see that A will be your answer. Number 10. A trader's closing inventory includes damaged items that originally cost $500. These items will cost $150 to repair, and they will then be sold for $600. At which value will these items be recorded in the trader's inventory? Well, remember that the principle that you need to apply here is lower of cost or net realizable value. Your cost is 500. Your net realizable value means your selling price of 600 minus any costs associated with selling it, which gives you 450 as the net realizable value. In other words, what you will actually get out of those assets. And if you compare these two, that means that this 450 is the lower and therefore the amount that you want to actually use. So we'll go and look for 450, and there it is as B. Number 12. The following information is available for a business. There's a draft profit given and a closing capital. The following error has been discovered in the accounting system. Private fuel costs of 1930 had been charged in the business motor expenses account. So what that means is that this should have been recorded as drawings, but instead it was recorded as an expense. What are the final figures for the year? Well, to correct the error, you would have needed to debit drawings or increase your drawings and credit motor expenses or decrease your expenses. So if we have a look at the profit, which of these would affect the profit? Only the motor expenses. If you are going to do a credit, you should automatically be able to realize a credit will increase the profit. And the reason for that is that your expense is decreasing. So it's a minus minus, if you like, and you will add it on, which means that your total profit will be 14,580. Your capital will be your 52780 that you start with, and in actual fact it's going to stay the same, but let me explain why. Firstly, your profit is getting bigger, so you would add your profit on. However, your drawings is going to increase, and so therefore your drawings, which decreases capital, needs to be minused. So this increase in profit and the drawings that is taken out actually offset each other, and that means that the 52780 actually stays exactly the same. I know it will feel very odd when you get this as your answer, and you may question yourself, but you are quite right, and this is why. You can then go and look for your answer of 52780 for the capital and 14580 for the profits, and there you can see your answer as C. Number 13. A creditor for $720 transferred from the purchaser's ledger has been entered on the wrong side of the sales ledger control account. Let's quickly deal with that first. What it means is that our sales control account, which remember illustrates a summary of all my different customer accounts, should have had a transfer from the purchaser's ledger. Now, if it's from the purchaser's ledger, and it's a creditor, it means that it would have to go in here on the credit side, as it would have been on the credit side in the purchaser's ledger. So we transfer it out of the purchaser's ledger by debiting the purchasers, and we credit the sales control account. So that is what should have happened. However, this is what did happen. It tells us we put it on the wrong side. In other words, we put it on the debit side. And as always is the case when you do a debit when you should credit or vice versa, it means that your correction will need to be a double entry, because you will need to do one credit of 720 to cancel out the error, and then another 720 to adjust for what you actually want it to be, what should have happened. The sales ledger control account has a closing balance of 92460 before correcting the transfer, and then a provision for doubtful debts of $1,000 is to be made. What is the correct balance on the sales ledger control account? Firstly, you would need to obviously start with the incorrect balance of 92460, which hopefully you realize should be a debit balance, because remember the sales control represents my customers and this is an asset account. So as an asset, it would have a debit balance. That means that my correction, which I have to credit, must therefore be minused. You then consider your provision, but notice that I've shown it here as 0. You don't even need to write it in at all. The only reason I put it there was just to illustrate for you that we're not going to use the provision, because remember, provision has its own account and will simply be shown in the statement of financial position when calculating your net trade receivables, but it does not come into this account at all. So therefore, my correct balance should be 91020, or answer B. Number 14. Draft financial statements showed revenue of $106,000 and closing inventory of $2,100. There were 100 items which had cost $10 an item, but which were for sale at $6 an item. At the year end, these were with the customer on a sale or return basis. These items were treated as having been sold, although no sale had been agreed. Now remember, IFRS says fair presentation. If the sale hasn't actually taken place, you do not want to show it. If you are still referring to the old GAAP principles, then yes, prudence may have been what was kept in mind over here. But remember that prudence has now been outdated and is overruled by IFRS's fair presentation. What were the values of revenue and of inventory when the principle of prudence is applied? So we now need to adjust these two figures here, taking into account the fact that the sale did not happen. So we need to reverse the sale that didn't actually take place. Firstly, we need to consider, are we going to value them at the cost of $10 or the selling price of $6? Remember, we want to show stock at the lower of cost or net realizable value. So because there's no sale, we're going to reverse it. The cost is 10, but net realizable value is 6, which means that we're going to value it at the $6 each times 100 items, means we're going to use $600 as the amount. Since the loss in the value from 1,000 to 600 should already have been written off before the sale was even recorded, that wasn't actually a sale, we don't need to worry about that $400. What would have happened is to take your inventory and make it into 600. You could just reduce your stock by 400, and if you wanted, you could show it as a loss due to obsolescence. Alternatively, you just use it as part of your closing stock in your cost of sales calculation, and then it just automatically works out for itself. So we only need to worry about the $600. Basically, what's going to happen is that your revenue would have $600 less in sales and should therefore be $105,400. And the contra to that is the fact that your inventory suddenly is a little bit bigger than what you originally thought and should therefore be $2,700. So you look for an option that has both of these figures, and you will see that number C gives you the option of revenue $105,400 and inventory $2,700. And the last question for today from the Cambridge Specimen Paper 1. On the 1st of January 2012, a business had prepaid rent of $50. During 2012, it made 3 rent payments of $250 each. On the 31st of December, the business owed $200 for rent for 2012. Now that's for the current financial year. The business owner only charged the rent payments made during 2012 in the income statement. What is the effect on profit for the year? Now, you would know you do need to take into account prepayments and accruals, but the business owner obviously is not very fluent in accounting and only charged the actual payments that were made. So that means that he only recorded that $250 times 3 payments, or $750. So let's have a look at what our rent account should have looked like. If we had a prepayment of $50, that would have been shown on the debit side as we'd paid it in advance, and it relates to an actual rent expense for this year. The bank figures should be there as they were there. And the amount owing at the end needs to increase the expense account, and the accrual itself would have been credited. So that means that my actual rent expense for the year should have been $1,000, or all of these added together to get that $1,000. But it was only $750. So therefore, you would have expenses being understated by the difference of $250, and therefore the profit would be overstated. And so you have a look for your options here, and you can see that your answer will be C. I do hope this was helpful.